Hey, what's going on? Right, time for another business valuation brought to you by emilynow.com. Let's take a peek here. Purpose of these live streams is to help entrepreneurs build a valuable business, because if you're going to put in the work and the effort to do something that's not going to be valuable or profitable, then why bother? And I think most entrepreneurs don't take time to work through that exercise. So these videos, live streams, are meant to help an entrepreneur or business owner just sort of think through some of the pieces of their business and what they should know about. And I do that through emilynow.com, MLENOW now, emilynow.com, which is an online web portal where you can get an instant business valuation. It's going to tell you what your business is worth now, what it should be worth. It's going to compare it to industry benchmarks. And so this stream is going to take you through a business that ended up sending their valuation over to me so I could take a look at it and comment on it. And I do have some. So let's get started and figure out if we can help this entrepreneur understand their business a little bit more. All right, so let's just zip down here. I'm going to do the manual entry. And let's just pop in the numbers here that the entrepreneur gave to me. So what are you looking for a business valuation for? They are selling their business. What industry are you in? They are in the administrative support, waste, and or remediation. It's interesting, this actually comes from, what are they called? There's like a National Association of Industries and National Association of Businesses, that stats and information are tracked, and banks and lenders use the same system to figure out how they approve loans and that sort of thing. So anyway, that's the category, that's the industry. The accounting system, they use QuickBooks Online, which is awesome. Speaking of QuickBooks Online, did anyone even catch today that MailChimp was purchased by Intuit for $12 billion? That's crazy. That's awesome. And MailChimp, of course, is a business that was bootstrapped. They didn't have any venture funding. They didn't do any of that stuff. They just got to work, kept their head down, got a big payday out of it, which is awesome. But anyway, let's get back to the exercise at hand here. Let's make sure you guys can see that. All right. Oh, let's see what's going on here. Thing about live chats or live streams, you just never know, do you? All right, let's take a look what's going on. All right, let me get us back. Let's take a look here. Technology is not perfect. And this is actually, I've not done a lot of live streaming, so I'm just figuring a lot of this out as I go as well. So let's take a look here and find out why this might not be working for me. Let's see here. Yeah, looks like we got a bit of a blank screen going here. Okay, so I'm gonna get rid of that. And let's try this again. Sorry, folks. I'm gonna figure this out. Maybe I shouldn't have flipped back and forth like that. Looks like that was probably the problem. Let's get my screen back so you guys can all see it. All right, thanks for bearing with me. There, I think we're back. Hopefully we're back. All right, let's see if we are. All right, maybe I'll just motor along here. And let's get back to business. Where is the math that I was given? All right, so just to recap, they're selling their business, we're administrative support, QuickBooks Online, and let's take a look here. Let's get some of this math in place. All right, total assets, 171, 711, total liabilities, 219, 864, which gives them negative equity. You know, I'm surprised as I do this, I'm surprised that more entrepreneurs don't realize that assets minus liabilities equals equity. You'd be surprised how many entrepreneurs aren't really familiar with their balance sheet. Your balance sheet is basically what does your business own? What does it owe? And the difference between what your business owns and what it owes would be the equity that it has. And in this case, this business owns assets of about 171,000. It has liabilities of about 219, which gives it negative equity based on their math of 48,000. They generate about $240,000 a year in revenue. Their cost of goods 85340, which leaves them about 155 grand to run the business. But they are spending more than that, 203,161, which is leaving them with a net profit of $20,000. And I haven't run the math, but I can see that that's probably wrong. So maybe I'll just pause here for a moment, because if you're an entrepreneur, your balance sheet, again, what does your business own? What does your business owe? And then what's the difference? What's left over? Well, your profit and loss statement is basically, what does your business make? What does your business spend? What does it have left over to pay for its expenses? What are its expenses? And then what's left at the end of the day? Most entrepreneurs also don't realize that the money from their profit and loss ends up on their balance sheet. So maybe I'll talk about that in a minute as I look at the rest of the math here. Okay, so let's take a look at the business value. And it looks like, yep, business is worth nothing. Negative equity, negative profit. There's no way this business could be worth anything on that basis. So I'm going to drop my email address in here. Let's see if we can get in. Get my top secret code. And again, you can do this too. Nothing special about what I'm doing here. Website is available to the public. I encourage you to use it. Lots of other individuals are using it as well to talk with their clients about their business. So, okay, there we go. Boom. So obviously we know the business is worth nothing because it has negative equity, negative profit. Let's just spin down here and take a quick look at that. Right here, negative equity, negative profit. Now the other thing is I can see that the math just simply doesn't work. So if you earn 240 grand, you spend $85,000 in commissions or product or whatever to generate that revenue, you've got $155,000 left over to pay for the expenses of the business. And if I subtract 203,000 from 155, I'm getting more than negative 20,000. I think it's going to be, what's that, closer to like, it's going to be like closer to 48,000. So let's take a look here. 203, 161, and back out 155, 195. Yeah, it's like $48,000. So we know this number is wrong, but that's okay. Basically, they're losing money, and this profit should find its way onto the balance sheet. So when you have profit, you either increase your assets. If you have losses, then generally you're increasing your liabilities. You take what you own, subtract it from what you owe, that's going to give you the equity. So negative equity, negative profit. This business is worth nothing today, but it could be worth over $100,000 if it was maximizing. You can see that, see it here. If it was maximizing its equity and its profit, then the business would be worth more. So what would that look like? Well, based on industry standards, it looks like the gross margin for this business should be about 140 grand. So if it's generating $240,000 of revenue, it should be generating about $140,000 worth of gross margin. That means that's the money left over to pay for the costs of the business. After it pays for its expenses, this business should be generating about $13,000 in net profit. And so if we take a look here at some of the flags, obviously we can see that the debt compared to the equity is way offside. So they've got to figure out a way to increase their equity by $100,000 and reduce their debt by that same amount. That's just a wash the way the math works. So you might say, Dylan, what does that mean in average person terms, or for an entrepreneur that is not a math genius? How would they figure that out? So I take $100,000, and if this business is supposed to be earning $13,000 a year in profit, I just divide that and say it's going to take this company about 7.5 years to generate enough money to increase its equity. So a couple problems there. What is working for it is that it has a decent gross margin. So that means 155 on 240. Let's take a look here. 155 on 240 means it's generating about 65% gross margins, which is great. So that means there's a lot of money left over to pay for the expenses of the business. But as you can see, the net margin or the profit margin for this business is zero. And the business has to figure out a way, if it wants to bring itself in line with industry standards, the business would have to figure out a way to reduce its expenses by $33,000. Given how much math is here, I'm guessing that this is probably a small business. Maybe it's probably an individual who runs a business by themselves, just by looking at the revenue numbers, or maybe there's two people in this business together. They're spending more money on maybe themselves than they are on the business. They're probably having to cover their own wage, but they're not generating enough. They're just simply not generating enough business to be able to afford the costs of their business. They can afford the cost of the product or their service or whatever it is they're delivering to the customer, but they can't afford to run their business. So they're running it at a loss. We can see here that the math is wrong, which means that if I look at their balance sheet, I go, well, if the business is running at a loss over here, then on this side, on the balance sheet side, I can see there's no money to build assets, which means their liabilities are running ahead of them, and they're in a position where they've got negative equity in their business. So that's kind of just the brush over of what this business looks like. But some of the things that we can talk about probably are applicable to any entrepreneur. So when you start seeing that your liabilities are ahead of your assets, that generally is telling you that the business is having some trouble generating profit. And so what does it mean? It means you're still paying for your expenses. We can see over here that the company clearly is paying its expenses, but how is it doing that? The way it's able to pay for its expenses is it's choosing not to pay its suppliers, it's choosing not to pay the government, or maybe it's choosing not to pay its loans off, or it's maximizing out lines of credit, credit cards, and basically the money that is made available to them from banks and from vendors is starting to increase. So the quickest way to turn a business around that finds himself in this position is to just start generating profit. That's simple. And you might say, well, Dylan, look at these guys, or this company here, they can't do it. You're right. So maybe the decision is to shut the business down. But the math is pretty straightforward. We know what we'd need to work towards with this business. We'd have to figure if this revenue is true, so if this is the most amount of money that this business can make, it has to figure out a way to reduce its expenses by $33,000 so that it has money left over, about $13,000 a year, to start contributing towards paying down its liabilities. And so to the extent that it pays down its liabilities, it's able to increase its assets. So a couple things here. Is it reasonable that this business could do more than $240,000 a year? I don't know. If I assume that that is the maximum amount of money that they can generate, then the other side of the equation is say, okay, if you can generate more revenue, then you've got to figure out a way to trim your expenses and bring your expenses down. That means they got to be able to bring their expenses down by about $33,000. On the other end of it, if they can generate more revenue, maybe they can't reduce their expenses at all, but they can increase their revenue because their gross margin seems to be in line. So if they can find a way to maybe double their revenue to go from $240,000 to $500,000, but keep their expenses exactly the same, most of that money is going to drop sort of right down to the bottom and give them the ability to even out and clean up their balance sheet. For me, in my experience over a couple decades, this is a pretty normal situation. A couple other things that I would notice with this particular valuation is that I'm guessing that the math and the financial statements just simply aren't up to date, because this is really straight math. Your revenue less your cost of goods means here's your gross margin is left. When you take your gross margin, you back out the cost of the business, it means you should have profit. I can see that if I take 155,000, I subtract 203 from it, doesn't equal 20,000. So there's some work to be done here with the entrepreneur and their accountant just to figure out why this math is wrong and isn't working for them. On the balance sheet side, I didn't even run the math, but let's just see if that even is correct. So hang on a second here. So if I take 171,711, I back out $219,000 worth of liabilities, I'm left with 48,000 negative. So that's correct. So their balance sheet is right. Their P&L, profit and loss statement, is wrong. Business is sitting in negative equity. If this is the most amount of money they can make, then they can reduce their expenses by $33,000. Means they're going to end up having about 13 grand left over in this business, which is going to take them about 7.5 years to balance out their balance sheet. Might not be a decision that this entrepreneur wants to make, but I am guessing there's some options here. So increase your revenue, reduce your expenses, do a combination of both, but figure out a way to put some money on the bottom line so you can bump over here and turn this negative equity around by reducing your liabilities. And again, this is pretty standard. You know, this is not unique. Having done this for as long as I have, I can tell you that entrepreneurs often have financial statements that aren't correct, or certainly they maybe don't understand the math. But I can also tell you that a lot of entrepreneurs think that just because this is how their business has come together, that this is in fact the best that they can do. And now that they've got a little bit of instruction or direction, that might give them the opportunity to change their outcomes and get the help that they need. And the way they do that is they can talk to their accountant, they can talk to a business coach, they can reach out to me. I'm a pretty easy guy to find. LinkedIn's probably the best way to do that. But oftentimes an entrepreneur just needs to be pointed in the right direction and they can fix their problems. And again, it's really important. You know, entrepreneurs take on a lot of risk to create these businesses, to provide meaningful income for people to live their lives in terms of employees and the folks that might be on your team. And but you want to run a valuable business. You want your business to be worth it at the end of the day. Your balance sheet tells you whether or not you're building a valuable business, and your profit and loss statement is the mechanism by which you end up doing that. And I'm telling you, whether you Google search it or you look people up online, there is no shortage of help available for you to build a valuable business. So there's no reason you can't. And certainly if you go to mlenow.com, emilynow.com, you can figure out for free what your business is worth and just do exactly what I did. It doesn't cost anything to do that. And so I would encourage you to do that. I've put all the math down in the notes here so you can take a look and run it yourself. And as you watch this video, you can sort of think through how does it relate to your business and what does your business look like. So anyway, hopefully that was valuable. Trying to, now that I think I've figured out how these live streams work, I'm going to try to do this on a much more regular basis because I spend my days talking about this sort of stuff. And if I'm able to put it in a format like this live stream, then maybe someone else can benefit from it as well. So thanks for tuning in. Make sure to hit me up, subscribe, hit the little ding bell, or little ding. I think there's a reminder that needs to come up. But I'd certainly love the opportunity to talk to you. I do this not because there's anything in it for me other than to maybe meet some entrepreneurs that are looking to fix their business and just need a little bit of direction. And it starts with figuring out what's your business worth, where is it breaking down, what help do you need, and then it's really just a conversation about figuring out how to get you to make sure that the time that you're spending on a business is worth it. So anyway, thanks for tuning in, and make sure to hit the notification bell so that the next time I pop up, try to do these in the evening.